Welcome to the SCORE Staten Island Demystifying New York Sales Tax for Small Businesses. We're going to give it another minute or so to allow those to log on.
Oh, we're up to 13, 16.
Welcome, everyone. We're just giving it a minute or so. Thank you for joining.
$18.
Okay, I think we should get started. Welcome, everyone, to the SCORE Staten Island Demystifying New York Sales Tax for Small Businesses, presented to you by SCORE, as well as our partner Flagstar. So we thank them. And we want a special thank you to Al Grillo, CPA, and he's also a SCORE Staten Island certified mentor and member. So it's thanks to people like Al and the rest of the SCORE community that we're able to bring you this type of educational material free of there's no cost associated with it. Our mission at SCORE is to support and vibrant small businesses within our community through education and mentoring. This is one of the educational features. A few house rules for today's webinar, which will take place from 1 till 2. There will be time at the end for Q&A. Your line will be muted, so please ask your question in the Q&A in the chat versus the chat. So on the bottom of your screen, there's a Q&A. In fact, we already have a question. A copy of the slides and the recordings will be sent to all attendees using the email that you provided when you registered. At the end, there will be a brief survey that will be sent to you at the end of this webinar. I encourage you to complete it. Give us your honest opinion, good, bad, or indifferent. And this also helps us to create content that is useful and meaningful to our clients. So with that, I will pass it over to Al.
Thank you, Gina. Hello, everyone, and thank you for joining us. Let me tell you a little about myself. Before I joined SCORE 7 years ago, I had retired. I was mostly in the corporate world. I'm a CPA, but I spent most of my time in the corporate world. The last job I had was with Con Edison. I think most of you know who Con Edison is. I was, for the last 15 years there, I was the manager of sales tax. I ran the whole sales tax function, which was very large. We collected about $400 million from customers. We paid out about $80 million of tax on our purchases. And we were always under audit, not because we did anything wrong, but because we were just so big and complicated. We had a great relationship with the New York State auditors, right up to the commissioner. And it was a very, very enlightening and educational experience. I bring a lot of that to my current job right now. I'm kind of semi-retired, but I do a lot of consulting for other CPAs on sales tax issues. It's very, very interesting. In the outset of my career, I never would have thought sales tax was that interesting because you really don't learn about it in school. But once I got into it, I found it was fascinating. So many things, and you're going to learn some interesting things today. But I'm only telling you about my Con Edison experience because I'm going to refer to it during the talk today. Because a lot of the things I learned there, you should be aware of, okay? And I'm going to start with a rhetorical question. Why are we even having this webinar today? Why is it important? Why did we think it's important for you, our SCORE participants, to learn about sales tax and use tax? I'm going to use those terms interchangeably, sales and use tax. Why is it important? Well, from your slide, you'll see a business needs to be aware of any possible sales and use tax implications because the failure to properly collect and pay sales tax can have significant implications. Okay, this is why we're alerting you to this. A business that does not properly collect sales tax can be assessed the sales tax and made to pay what they should have collected. Even if they didn't collect it, they've got to pay it over. Okay, that could be a very significant financial implication to you. And we don't want that to happen. That's why we're doing this. And this tax can be assessed to the business owner, even if the business is doing business as a corporation. Okay, so being a corporation will not protect you. So we're talking, you're the responsible person, and we're going to go into what that means later on. So this is a very, very serious business that we're talking about. What we want you to do, though, is when you go into business, understand that you need to know what you're doing up front. You can't wait till a year or so later, like if you were doing your corporate income tax return. This has to be addressed before you even start the business, okay? And the other thing I want to stress, and I'm going to stress this a few times, you need to talk to a qualified financial person who can guide you through this, at least in the initial stages. Once you're up and running, it won't be too difficult. But depending on the products you're selling and where you're selling it, you need to talk to somebody ahead of time, okay? Gina, can we go to the next slide? Okay, I think we skipped one. Maybe we could, very good. What is sales tax? Sales tax is a tax that you could call it a gross receipts tax. It is a tax imposed, okay, on the retail sale of goods, on sale of personal property, tangible personal property, and services. Now, there's a distinction between tangible personal property and real property. Real property, as you may know, pertains to real estate, land, buildings, something you can't move, something that's permanent. Tangible personal property is something that you could touch and something that you could move, okay? Services, different kinds of services. Some are taxable, some aren't. If you go to the doctor, they don't charge you sales tax. But if you get your car repaired, they're going to charge you sales tax. So there's the difference, okay? What is use tax? And this is a tough one because people aren't always aware of what a use tax is. A use tax is a tax that the consumer pays directly to the state, okay? So if you buy something from, say, a vendor who doesn't collect sales tax from you, say it's an out-of-state vendor, and they don't have any responsibility, they ship it into New York, you, as the taxpayer, have the responsibility to pay sales tax on that item. Now, most people don't, okay? They're not aware, the amounts are not significant. But if you're in business and you buy something, say you buy software, $2,000 worth of software, okay? And you're not charged sales tax, you should report that to the state and pay the sales tax. Because if you're a big enough business and you get audited, that's one of the first things they're going to look at is your expenses. Did you pay sales tax on everything? So be aware that if you, just because you don't pay sales tax to the seller doesn't mean that you're not liable for that. And that's called use tax. It's a consumer use tax. If you buy something and bring it into the state for your own use, that's the use tax. Okay, next slide, please. If you're starting your business, obviously you want to have good business records. Okay, and that's important not only for sales tax purposes. If you're ever audited, you're expected to have good, reliable business records, invoices, daily sales logs, bank statements, things like that. Keep your invoices. I've seen situations where people pay bills and then just throw them out. Not a good thing to do. You want to keep your business records. You always want to keep good business records anyway, because by not keeping good business records, people could unfortunately steal from you. You could also make the mistake of not billing your clients properly or forgetting to pay vendors. Those things are going to cause problems for you. In accounting, we call those internal controls. You want good internal controls. They don't have to be elaborate, but they have to be there. Okay. You want to control your inventory. You want to make sure people can't come in and just help themselves see your inventory. You want to make sure your bank account, especially nowadays with all kinds of online theft, you want to make sure your passwords are secure, things like that. But you do want to have good business records in case auditors come in and want to look at all your invoices. Of course, depending on what business you're in. If you're selling 1,000 items a day, you're not going to keep a record of every sale. But if you're a contractor doing 3 jobs a week, you're certainly going to have invoices, okay, for that. Okay. Those are the books and records. Once you've determined that you're going to have to collect sales tax, and again, this is up front before you've even started the business, you want to apply for a sales tax certificate of authority. And what you do then is you go online and you have to get certain information. I'm going to go through this in a little more detail. But once you've done that, you have to start filing sales tax returns if you're collecting sales tax. To file a sales tax return online with the state, once you're registered, is a relatively easy thing to do. You have to put down your gross sales. You would subtract your exempt sales if there's any. Okay, sales to someone who's going to resell it, they would give you a certificate, or sales to nonprofits. Okay, those are exempt sales. And that would give you your taxable sales, the difference. The taxable sales times the tax rate is what is the amount of tax that you turn over to the state. Hopefully that's what you've collected. Okay. Then there's all kinds of, if you've got any purchases where you didn't pay the sales tax, okay, that would be your use tax. You would pay that at the same time. Okay. There could be some credits. So for instance, if you collected sales tax from someone and paid it over, and then you had to refund the sale. So then you have to refund the entire amount, including the sales tax. You would get a credit for that. So that's the whole process. It's not that difficult. You could probably do it yourself. Most businesses can. Okay, accountants can help doing it, but you could probably do it yourself. We always recommend that even if you have no sales tax liability, but you're registered for sales tax, so you didn't have any taxable sales, file a sales tax return. Why do you do that? Because when you file a sales tax return, you begin the running of the statute of limitations. And what that means is, once you file a sales tax return, the state has 3 years to audit you. After 3 years, they cannot audit you anymore. Those years are closed. If you don't file a sales tax return or any kind of return, even your personal tax return, they can't come back. They can come back if you don't and say, we want to look at those years. And you'll say, but that was 5 years ago. Yeah, but you never filed a sales tax return. You never filed a personal income tax return. We can look at everything because those years are still open. So filing a sales tax return, even if there's no activity, is highly recommended. It's very simple. It could take you maybe 10 minutes to do online. You get a receipt. It's all very easy for you to do. That's one of the most simple things we're going to talk about today. Everything else is going to get a bit more complicated, but do file all your sales tax returns. The state may be looking for them. If you're filing corporate income tax returns, file it because they may match things up with it. Okay, but you've got an answer for them. We want to protect you. That's what we're looking to do today. Okay, Gina, can you go to the next slide, please? How do you get a certificate of authority? There's a lot of information here. Okay. This takes a little while longer, but it's not that bad a job if you have all the information available. What they're going to ask for is, what is your business? Why do you need the certificate of authority? Why do you think you're going to have to collect sales tax? And you put that down. Then you have to put down certain information. The most important thing is the responsible person information. That's generally the CEO or the chief financial officer or the owner. The owner may be wearing all those hats. Once you put that down, they're going to want to know that person's home address, their phone number, and then social security number, bank account. So when you file tax returns, that information is available. And all of this information, because that person will be personally responsible for paying any sales tax that's not paid. Okay, I have experience with this working with other accountants where the state will come back and ask for that personally. They will assess individuals for sales taxes. Okay, it's very important that this is done right. And if you sell a company, say, you want to make sure you're no longer the responsible person for the period after you sell the company. So that's very important. Again, once you get the information lined up, it's not that difficult to do. Okay, can we move on again? Okay, this is the checklist. If you're going to do this, you could share this with your accountant. And again, not too difficult once you get all that information. Next, please. Okay. At this point, I'll just take a break. Do we have any questions, Gina?
Yes. Is there a contact regarding sales tax in New Jersey? I have a new company, the gym. I don't believe they need sales tax, but they will be selling merchandise.
Okay, the New York State Department of Taxation, in New Jersey, they have lots of contact information. Okay, they're a little easier to get in touch with than in New York. They're a little smaller. But if you go on the New Jersey Department of Revenue website, you can find it pretty easily. Okay, I have that information too. If anyone needs to contact me, I could get you in touch with them.
The other question.
Oh, I just want to say some other thing. Be careful because some services may be taxable. Okay, you might not think though, but a gym membership may be taxable. It's possible. In New York State, they're not, but for New York City purposes, they are. So you have to watch the local taxes also.
The other question is on Form ST 121.2 for purchases of promotional materials. Can you provide examples of promotional materials that are exempt from New York sales tax?
Okay, one of them that I know, most promotional materials, if you're going to give them away, okay, they're going to be taxable. So if you buy, say, coffee mugs, to give away, they're going to be taxable. Certain things that if you, and I remember from my Con Ed days, if we had printing done, printing is normally taxable. But if we printed, say, a circular that we were going to put in like a bill insert, that would be exempt. Okay, these things are pretty technical, so you're going to have to look at the specifics, and they're usually on the form, okay, for promotional materials. But I would say most things there may be exceptions, but I think most things are taxable.
Okay.
Of course, if you're reselling them, they're not going to be taxable when you purchase them.
Okay. And then there was a question within there about a certificate of authority.
Yes. That's what we just went over. I mean, we may have covered that, but yes, if you think you're going to need to collect sales tax, that's when you must get the certificate of authority. You want to get that before you even start business. I recently, several months ago, had a situation that was brought to my attention where a taxpayer had been paying tax, collecting, was in full compliance. Everything was going fine for about 5 years, and got a notice out of the blue that they didn't have a certificate of authority. Very strange. It took them that long to ask this person, hey, you don't have a certificate of authority, and yet you're filing tax returns, you're paying the tax. Guy was doing everything right. but he never had a certificate of authority for some reason. So I had to go ahead and get him one. It turned out very well, but you can operate, but you're not supposed to, not without a certificate of authority.
Here's an interesting one. Is a subcontractor a construction company which provides services only to another construction company, the general contractor, required to apply for a New York State certificate of authority? And is it required to charge sales tax to the general contractor?
Okay, it depends a lot. First of all, they should, all right? They should have a certificate of authority because they may be collecting sales tax on certain jobs. Doesn't necessarily mean they're always going to be a subcontractor. So they should make it to a point where they could always be able to collect if need be. Okay, generally a subcontractor who is, say, working on what is considered a capital improvement will not charge sales tax. So for instance, what is a capital improvement? That's one of the things I'm going to talk about. A capital improvement is an improvement to real property, and it's generally permanent and extends the life of the property, and it increases the value of the property. A perfect example is you put a new roof on a house. Okay, you would not charge sales tax on that because it's a capital improvement. So a contractor comes along, he puts a new roof on a house, he gets a capital improvement certificate from the owner. The owner says, yes, this is a capital improvement. You're not charging me sales tax. So a subcontractor would not have to collect sales tax on that. They would bill the contractor, who then would bill the homeowner, but there would be no sales tax. However, and a lot of people don't understand this, it's not totally tax-free, because when the subcontractor or the contract buys materials, those materials are subject to tax, and the tax is just built into the cost. So as far as the subcontractor may be buying a lot of materials. If they're doing, say, repairs, when they do pay tax, they could get a credit for that. So I would recommend any subcontractor register for sales tax, get a certificate of authority, and file sales tax returns. Again, it's important because you get that statute of limitations running. So there's a lot of issues here. This is an area I'm very familiar with, working for Con Edison. We used to spend about $2 billion a year with contractors. So yes, definitely they should register and file tax returns.
And one more about, sellers from out of state, in this case, Ohio, shipping to New York.
Mm-hmm.
What should people do, as well as doing business with the Port Authority?
Okay, the Port Authority, that's an interesting one. Port Authority would be considered an exempt organization. It's like a governmental entity, and they would be tax-free. So I guess the question is, if somebody's shipping from Ohio, a company in Ohio, doing business with the Port Authority, the Port Authority would give them an exemption certificate. Okay, and that they would not have to charge sales tax. The Port Authority, on the other hand, would not owe any use tax, even though they're buying it from a vendor who's not charging them sales tax. They would not pay sales tax because they're like, again, a quasi-governmental entity, as if they were a church or the local public library. We're going to talk about exempt entities later on.
That's it. I think you can get back to the presentation at this point.
Okay. What you're seeing in front of you, there is a lot of information out there as to guidelines for sales tax. Some of these cover things that are, many of these have things that are repetitive. But the sales tax publications from New York are very, very informative. If you have a particular kind of business, if you're a contractor, if you're a supermarket, if you're an advertising agency, basically whatever you do, there should be a publication out there that could provide a lot of guidance for you. Okay. Go to these things. They're right on the state's, New York State Department of Taxation and Finance website. Very easy to find. You could actually look at this, just type in those things like TB-ST-640, and you'll get something for business, it'll tell you what kind of business you have when you're filing for a certificate of authority. There's very detailed, really detailed information, what foods are taxable, the difference between candy and, say, regular food. Candy's taxable, other food isn't. Okay, prepared foods, all kinds of detailed stuff. If you're a motor vehicle dealer, if you're a restaurant owner, there's stuff out there for you. And that's why I wanted to put this there. It's very, very useful information. Go to the next one, please. Okay. Products and services subject to tax. Now, this is interesting. I said tangible personal property is taxable. Most items of tangible personal property are taxable. In certain situations, you could buy something, and if depending on what it's used for, that may mean it's not taxable. For instance, when I worked at Con Edison, we used to self-assess tax. We didn't pay the tax to the vendors. We would self-assess, we'd accrue, that's the accounting word. We'd put a liability on the books when we determined that something was taxable and we were using it. And why is this? Well, the state said in our business, we were allowed to do that. Now, we weren't going to close up and run out of state. They obviously knew that we were a regulated utility. So they gave us the option of self-assessing. The thing was, when we bought something, we didn't know if it was taxable or not. And we didn't know where we were going to use it. For instance, we used to buy transformers, and you see transformers like, on light poles and things. And we bought a lot of those. We would buy them and put them into inventory. And then we would take it out of inventory when it had to be used. Sometimes it was used for production. We used a transformer to produce electricity. When you're a manufacturer and you're producing something, anything you buy is generally tax exempt. Okay, so it was tangible personal property, but because of how it was being used, it wasn't taxable. So we would write that down. We would account for that in our systems. So we would take it out of inventory, but it was not taxable. On the other hand, if a transformer was being used to transmit electricity, where it wasn't producing, it was in the transmission process. Okay, that was taxable. So then the system would make it be coded taxable, and we would accrue the tax. The next question is, where are you going to use it? Okay, so in New York City, we know what the tax rate is. It's 8.875, and we would pay the tax. However, if we were buying something and we were going to use it, say in Mount Vernon or Yonkers, we would have to accrue it to that place, because then that city would get the tax. The state would get part of it, and they would get the other part. So we didn't know if, number one, if it was taxable or not, and number two is if it was taxable, where is it going to be used? So we were allowed to do that. So there you have a situation where tangible personal property isn't taxable. Okay. Now, certain things like gas, electricity, these are considered tangible personal property. You could touch electricity. Now, I wouldn't do that because you're going to get a bit of a shock, but it's considered tangible personal property. Services. What are services that are taxable? Okay. If you go to the doctor for a checkup, that's a service, but it's not taxable. Generally, people who have a professional license, an attorney, a doctor, an architect, a CPA, a lawyer, those services are not taxable generally. Okay. But if you get your auto repair, if you leave the doctor and get your auto repair, got your oil changed, that's going to be taxable. But if you're there at the same time getting your car inspected, that's not taxable. So it really depends on what the service is. Okay.
So Al, one of the questions was for an interior designer. What would that fall under, like an architect? Or...
I think, if I recall, an interior decorator is taxable. There is a publication on that. They specifically address that one. And if I recall, an interior designer, a decorator, is taxable.
And will this quick reference guide answer that question for this
It
person?
should. That should be, if you go to the state's website, you type in sales tax interior designer, you'll probably get your answer. It'll probably bring you right to the publication. Again, this is something, if you're going into this business, this is something you should discuss with your tax professional. Now, even foods are different. And the food is a tough one because, you could buy a frozen chicken in the supermarket. That's not taxable. Or you can go to a fancy restaurant and have a chicken dinner, and we know that's taxable. But what if you buy, say, cooked chicken cutlets at the deli? Or you buy a chicken sandwich? It gets a little more complicated. Generally, if you could buy food that's ready to eat and they provide a place to sit and eat it, it's going to be taxable. Okay. Or food that has been prepared in a fashion that you could take it and eat it. So you go up to a window, buy a sandwich, and walk away with it. Generally, that is taxable. Okay. It's complicated food. And this is, again, one that you have to look at. It's a strange thing. We joke about this, but about 25 years ago, New York, in its regulations, talked about marshmallows. And this is ridiculous, I know, but I'm going to tell it anyway because it's so ridiculous. Marshmallows were considered taxable if they were large marshmallows. They were considered candy. Small marshmallows were considered food and not taxable because you could use them in baking and things like that. So you had small marshmallows and not taxable, large marshmallows taxable. And someone came along and said, this is ridiculous. And they changed the rules. So now all marshmallows are not taxable. They're all tax exempt. If you look in the regulations, it'll actually say among exempt items is marshmallows. And in parentheses, it says all sizes. So that's why this stuff is really complicated, and you really got to look at the specifics of each situation.
So one of the questions, we've all gone in and got our bacon, egg, and cheese from our local deli.
Right.
Are they charging tax? Should they be charging tax?
They should be charging tax on that. Yes, because they're actually preparing something for you. Once there was another one was about the bagels. If you bought a bagel, it wasn't taxable. But if they cut the bagel in half for you, it became taxable. That's actually in the law because you're actually preparing food. That's why you've got to look at the specifics of each situation. In a business, again, a business can easily have taxable and non-taxable items that they sell. You can make that sandwich and buy a quart of milk at the same time. The quart of milk is not taxable. Again, we're trying to not answer every situation, but alert you to the fact that you may have a situation that requires further research. And I keep going back to the point, talk to your tax professional. And when I give these talks to CPAs, I do the opposite. I tell them, talk to your clients. See what they're doing. Are they into any new businesses, any new products? Have they moved into any new tax jurisdictions? There has to be open communication all the time, back and forth. Okay. Let's see. Okay. Shall we go to tax not subject? So we talked about what is not taxable. Again, most services from professionals, doctors, lawyers, accountants, medicines, things like that. But there are other exemptions. And going back to the contractors, here's a good one. When a contractor buys material, even for a capital improvement, it's taxable. However, if that material is going to be attached to some real property that is owned by a nonprofit or a governmental unit, it's not taxable, and you can get an exemption certificate for that. For instance, if a contractor is hired to pave a street in New York City, any material, any asphalt that they purchase should be tax exempt. And they don't have to pay sales tax on it when they purchase it. They should get an exemption form from the city and step into the shoes of the city and buy that tax-free. Okay. That's one of the things. Any anything purchased for the manufacturing, we talked about this before. I talked about Con Edison, but any manufacturing company who's buying materials that's going to be manufactured, and manufacturing could be many, many things. It's not just, what we typically think about as in a factory, but any kind of manufacturing where you're changing a tangible personal product, any kind of material rather, being tangible personal property, if you're changing it into something else for resale, that's manufacturing. And anything you buy should be tax exempt. Okay, so be aware of that if you're a manufacturer. Okay, I also want to talk about, I talked about the capital improvement exemption, to real property, putting a roof on a house. Another one I want to talk about is dealing with tax exempt customers. I briefly mentioned that. If you have a customer who claims they're tax exempt, they should have gotten a form from the state of New York stating that they're tax exempt. Some of them are obvious, like the city of New York, the federal government, the United Nations, but there are a lot of tax exempt organizations out there, and they can get this form from the state. Before you sell them anything, and don't charge them sales tax, absolutely get the tax exempt form from them. Because what happens is, over time, if you don't get it and don't charge them sales tax, a lot of these companies, small tax exempts, go out of business, or they forget to send you the form, and you could be selling to them for years without having the right form. This is a big source of assessments on audits. Okay, do not charge, I should say, always charge sales tax until you get the tax exempt certificate. And you must also keep good control over those tax exempt certificates, because they will be asked for if you're ever audited. Very important. You can accept them. You're not the tax exempt form police. You don't have to go investigating. Okay, but if you get the form, assume it's correct and keep it on file. That's what we talked about, keeping good books and records. Keeping exemption forms is keeping good books and records. Thank you. I want to move on now. Okay. How does a business get selected for audit? This is always a question that comes up. Well, there's many, many ways. They audit one business and see a lot of invoices from another business. And they could say, well, this doesn't look right. Why aren't they charging sales tax? That's one way to do it, okay? Also, we talk about whistleblowers. Somebody could say, hey, that guy's charging me sales tax, and he's bringing up the bill is no sale, and he's charging me sales tax. Or it could be a disgruntled employee. New York State has a program where they run all the business returns through their computers, and they call it CISS. It's a corporate information selection system, and they could cross-check a lot of information. That's one way of doing it. That's mostly for bigger customers. A consistent taxable percentage. This is an interesting one because this happens a lot. A business will have a certain percentage of taxable sales. Generally, say 30% of their sales are taxable. And every quarter they file, and it's always 30%. They never change the rate. That's one way when the state could run it through the system and always see the same taxability rate. That's the way they say, hey, this doesn't look right, because generally things aren't always the same every quarter. Should be reasonably close, but not exact. That's another one. It's a strange thing, but it does happen. They can match up your corporate sales, your sales tax returns, your corporate income tax returns over a period, and look and think if things don't look right. Okay, that's another one. This is an important one. Information returns from insurance companies. So if you're an auto repair shop and collecting insurance, for repairs, auto repair shop, the insurance companies will send information to the state. The state's going to know if you've collected something. Okay, state liquor authority, they know how much a business is buying of liquor. Okay, and also there's financial institutions, there's credit card companies. These are reporting all of these things. So there's a lot of information out there. So the thing is, do it right. Okay, and you shouldn't have any issues. They also look for the same, businesses in the same area. If there's 20 pizzerias and they all have similar numbers and one stands out, they could find that out pretty easily. Okay, there's credit card sales. They can look at that. If somebody's not reporting it. And of course, there's lottery sales. If you've got a business that's reporting a high volume of lottery sales, say a card store, and very little in the way of cards, greeting cards, that's another thing. So there's many ways. They generally go after larger companies, okay? And you have to be in business for a few years, but you can get audited, okay? But these are just, if you're doing things right, you shouldn't have a problem. Can we move
Well,
on?
Yeah, this
Yes.
is another question. If someone didn't file an ST 120 for previous years, can they go back? What can they do? Like
Oh,
how?
yes. Yes. You mean the ST 120, the sales tax return?
Yeah, yes.
Yes. You could always go back and file. They want voluntary compliance. In fact, there's such a concept called a voluntary disclosure agreement. If somebody realizes that they didn't file and they want to come clean, you could have an accountant or attorney do it for you, anonymously. They can approach the state and say, listen, I've got somebody here who wants to voluntarily file. They've made an error, they didn't know, and can they do this? And the state generally, they want you on the tax rolls. They want you filing tax returns. Okay, they're not going to come after you and beat you over the head. They want you to file. So you could actually, you're going to pay interest. There's always interest due, but you can actually get the penalties waived. And so that's what we call a voluntary disclosure agreement. Mostly all states offer them. States want to get you compliant. That's a big goal. Okay, now here's the certificate of capital improvement. This is very easy to fill out. It's interesting, when I was working at Con Edison, I deal with engineers. They always got nervous about filling one of these out. It's 2 pages. It's very simple, but when people seem to get intimidated by tax forms for some reason, I have engineers who file a 75-page environmental report with no trouble. But if you ask them to file a 2-page sales tax exemption form, they get all nervous. It's really not that hard. Okay, you just describe what you're doing and you hand it to your contractor, or if you're the contractor, you get it from the customer. Next one. Okay, this is an AU11. This is if you file sales tax, if you pay sales tax rather, and you discover that you shouldn't have or you weren't required to, this is how you get a refund. And a lot of companies will do this. They'll go through their books, say after they've been audited, and discover that, we paid sales tax on some purchases and we didn't have to. Well, this is how you get that money back. I actually had this myself. I had an awning installed. It was a retractable awning, and the salesman insisted that I had to pay sales tax. And I said, I really don't think so. He said, no, you have to. I said, so I just wanted to get the awning. So I paid it. I paid the sales tax. So I found the support in these forms that I showed you, filed a form, filed the AU11, and got my sales tax back. It's very easy to file. You just put a description, you put the support. This is not something you would do on your own, but your accountant could do it for you. The thing is, if once you pay it, you can get a refund, okay? If you've paid it in error. Only the person who paid the tax, though, can get this. If you're a seller and you've discovered that you've been charging sales tax and you shouldn't have, well, then you can't go back and get the money. Only your customers can. Okay, next, please. Okay, this is something I want to bring up. It's important. Actually, this question came up the other day with one of my colleagues. If you're going to buy or sell a business, this is the form that you should look at. It's a bulk sale transaction. If someone is going to buy a business, there may be sales tax implications. This is a very good form in that it protects both the buyer and the seller. I bring this to your attention because you may be considering buying a business. Okay, a lot of you may be out there. look at this, because if you buy, say, a restaurant, you may have to pay sales tax on tables and chairs. Maybe not on the ovens, but on the tables and chairs, on the plates and dishes and everything else. It's something, it helps everybody to be clear as to what is taxable and what isn't. And this is a very useful form. Again, it protects everybody. It protects the seller, it protects the buyer, and it's easy for the state to see where everybody's up to. If you want to do things right, I highly recommend this. I recommend this to CPAs all the time, that if they have a business that's going to be buying or selling, definitely take it, use this form and pursue it. Next, please. Okay, now we're into the new section. This has to do with selling online. And I see we're a little pressed for time. Any other questions before we get into this?
Yes. So a question about, he fits golf clubs. He charges one price for sales tax for the clubs, but not for the time and service of the measuring. So it's almost like a tailor saying, I'm going to make your suit, but not charge you for the service of measuring. We've stumped Al.
That's an interesting one. I don't know the answer to that question. I have to say, I don't know. If that person would like to email me, I could take a look at it. That's an interesting one.
Okay. Grocery store that also sells New York State lottery tickets.
Right. Well, obviously, lottery tickets are not taxable. Okay. We brought up this thing about lottery tickets because as part of the audit process, if they're not reporting any other sales, okay, if all the sales are going in somebody's pocket, that may be an audit issue. Okay. So if you got a very, very high volume of lottery sales, but very low volume of other sales, you may have an issue there. Okay. But they are not taxable.
Yeah, I think someone restating a question. I did not always collect ST-120s, resale certificates, from other businesses that were buying parts for resale. What should I do?
Go back and get them now. Try and get them now. I mean, there are other ways to show. If you're selling to Walmart, okay, if you're selling sneakers to Walmart, 100,000 of them, obviously that's for resale, okay? So auditors will look, they'll use their common sense most times to determine, yeah, I see who you're selling to. I know this is not taxable, but you should have those resale certificates. Go get them now.
Okay, and the last one is on form ST-100, again, about the lotto tickets. On what line do you report that on the ST-100?
I don't know if that is actually reported on there. I have not seen, I don't think, there may be a separate form for reporting that. It might not even fall under sales tax. Because that's with the State Lottery Authority, I believe.
Right. So that was it on the questions. If you
Okay, let's get into NEXUS. Now, we were talking about online sales. This all has to do because in 2018, the Supreme Court heard a case called Wayfair versus South Dakota. And in that case, the state of South Dakota says, even if you have no business presence in the state, no nexus, and nexus is defined as a minimal business connection. Okay, if you have no business, if you never step into a state, you have no employees there, you don't have any inventory or anything, you don't have nexus in the state. State of South Dakota says, I'll just take a drink for a moment. State of South Dakota said, we don't care. We believe you have a nexus if you're selling 100 items, you've had 100 sales transactions, or say $100,000 in sales. We want you to collect sales tax from customers in South Dakota. Well, of course, Wayfair was the test case. They went up the courts, and the courts said, we're going to revisit what happened. In 1992, we decided in a case called Quill versus the state of North Dakota. I don't know what it is about the Dakotas, but in 1992, they said, no, you can't require somebody to collect sales tax if they're not coming into your state. Well, in 2018, they said, yes, we think you can. Why? Because the business environment changed. The world changed. We had the internet. In 1992, very few people had the internet. There were no online sales. You might call up a company to, ship something to you, but nobody went online. In 2018, the world had changed. Computers were so prevalent that you could actually collect. There were systems to help you collect the sales tax. Now, South Dakota was thinking, our residents owe that tax, but we can't collect from all those people. But if you collect it, it's easy. Then you could turn it over to us. So the Wayfair decision became law. So now, of course, once that became law, all the states jumped on the bandwagon, except we have 5 states which do not collect sales tax. They don't impose a sales tax. They're known as the nomad states: New Hampshire, Oregon, Montana, Alaska, and Delaware. Those are the 5 states that don't have an income tax, the nomad states. But every other state has a sales tax. So if you're doing business in another state and you're selling enough, if you're selling $100,000 worth of merchandise into a state, you are going to have to start collecting sales tax on those sales. And that's what we want you to know about. I don't know if anyone on this call or on this webinar today is going to have that situation, but you might. You get a few big customers and you could do it. And if you are, you have to get registered with the state that you're selling to and start collecting sales tax. That means you got to maybe upgrade your billing system to collect that money. But it's very important that you do. Okay, if you haven't been, once you hit that $100,000 threshold or whatever the threshold is, you have to start collecting sales tax, usually in the next year. Okay, but we wanted to make everybody aware of that because I know there's a lot of online businesses, and that's the big decision, the Wayfair decision. That really changed the world in the sales tax world. Very, very big difference. Okay, next. Okay. These are the states that, now you see on the far right, those are the nomad states that I mentioned. The 2 next to it, Connecticut and New York, actually have very high thresholds, which is strange because they're very aggressive states with high taxes. But Connecticut and New York said, not only do you need, say, 100 transactions, but you need to make a number, a lot of sales. I think New York is 200 transactions and 500,000 in sales. Combined, you have to meet both thresholds. So New York is really strange in that they make it hard to have to be required to have sales here. I mean, to collect sales tax. But, that's strange again. But all these other states on the left, you can see most of them, if you're hitting that 100, you're going to have those taxes, 100,000. A lot of them had the 100 transactions. They're starting to drop that because they realize 100 transactions at, say, $12 a piece isn't going to amount to a lot of tax. So they're getting away from that, and they're mostly going to start using a dollar threshold. Look to see if you have anywhere near $100,000 in a state, you have to look into whether you should be registered there or not. That's something to discuss with your accountant. Okay, next, please. Okay, here's some mistakes that people make when they possibly could be going into another state. All right, you expand your products, you start selling to more states. Okay, that's an indication that you have to monitor. What am I going to be required to collect here? If you have new employees, okay, and they're in other states, you may be required to collect it. That may give you NEXUS. Okay, if you have an employee in another state, it's like renting property in another state. You're doing business there. Okay, do you have a warehouse that you ship goods to and then somebody else ships them out for you? If you have a warehouse, you're in business in another state. You may have to collect in that state. Okay, changing of staffs. This is a biggie because a lot of times if you lose people who are working on sales taxes or anything for that matter, the new people may not be aware. So they make sure that if you change staff that they're well trained. Very important. Product expansion, talked about that briefly. If you're selling something that's not taxable, and then you find, well, I can make some more money selling something else, a new product, but this, all of a sudden it's taxable, then, that could trigger taxes. And audit notices, always pay attention to audit notices. Don't ever ignore anything, okay? Is that our last one? Gina?
Mhm. Yes, and I think.
Oh, okay.
Third-
Yeah, this is the streamlined sales. I just want to briefly mention this one. I don't think you're going to get involved with this, our viewers today, but if you're dealing with a lot of states, there are a number of states, I think it's maybe around 25 to 30, who got together and tried to simplify the sales tax filing. You can you go to this website and you can register with all of the states at once. You put in all your information once, click on what state you want to be registered in, and you could register. They made it really easy. It's a very good program called Streamlined Sales Tax. New York is not a part of it, but I believe New Jersey is. And it's a very useful thing to know about. Okay. Any more questions? I think we're almost at the time limit.
Yeah, we're almost done. I do have a question.
Yes.
So when you're on these online eBay, all these
Mhm.
platforms, they take care of all of that,
They
right?
generally should. If you're the seller, if somebody's selling for you, you should always be assured, get it in writing, that they are collecting the tax and turning it over. Make sure you get assurance of that. Very important.
And the other thing is, yeah, before the internet, though, we did have mail catalog.
We did have mail catalogs. You're right, and they were pretty good at it. I remember ordering from catalogs, and you would call up and they would ship to you. But a lot of these were bigger companies who had what we call NEXUS. So if you ordered from Macy's, they were mostly all over the place. So they were required to collect sales tax to the place that they shipped it to. And they were pretty good. They usually knew the law very well. If something was exempt in that state where you were in, or even if they were having, say, a holiday for 2 weeks, before school, sometimes there was no tax on children's clothing. They were well aware of that. So yes, we did do that, but it was mostly larger companies who did that.
Okay.
And they were filing anyway, so they had to do it anyway.
So we are at you made it, Al. You got 2 minutes.
Yeah, we did it.
There. I believe we answered all of the questions. As I said, the presentation along with the recorded webinar will be emailed to those that registered. So thank you for attending. A special thanks to Al. SCORE is a nonprofit association dedicated to helping small businesses get off the ground, grow and achieve their goals through education and mentorship. We've been doing this for more than 50 years because of our work. Because our work is supported by the U.S. Small Business Administration, and thanks to our 10,000 volunteers, people like Al, we are able to deliver our services at no charge or very low cost. At Staten Island, we aspire to only do no charge webinars, so there will be more to come. Please send us your survey so that we can help you better. And thank you all for attending.
Thank you, everyone. And remember, if you have